Welcome, everybody, to the Directed IRA podcast. I'm Lindsay Mersino, the Executive Director of Operations here for Directed IRA. And I've got Mark Miller here with Hilton Wealth with me in beautiful Phoenix, Arizona today. How are you?
I'm doing great. How are you?
I'm doing great. Thanks so much for traveling all this way to come visit with us and check out our operations and do a live webinar with us.
I'm excited to do it with you.
So what we do here at Directed is we're simply a qualified custodian for alternative assets. Again, we've got over 22,000 clients and we custody over 3 billion assets at this time. So we've grown substantially in our short time that we were founded. And a lot of that is accredited to different companies out there that believe in alternatives as well. So that also leads us to strategizing with different advisors, such as Mark Miller with Hilton Wealth. And we're, again, excited to just hear more about an advisor's perspective on alternatives, since not all advisors know how to get into alternatives. Quick disclaimer before we jump into all the good stuff. None of this today is legal or tax advice. Even though we do have an advisor here with us today, this is not for tax, legal, or investment advice, guys. You know the drill. We're here to plant seeds. We're here to educate. We're really here to just make things come to life as well for you. So planting those seeds, and you let us know which areas we can help you further in. But none of this is advice. Please do not misinterpret any of it for advice. So again, we've got Mark Miller from Hilton Wealth Advisors here with us. He's got over 40 years of experience in helping business owners. So Mark, I'd love to hear a little bit more about you if you don't mind giving us a quick intro.
Absolutely. So Hilton Tax and Wealth Advisors, we're a spinoff of the Hilton family office. And basically, Brad Hilton is my main partner. Brad is the grandson of Conrad Hilton. And Brad and I had this idea, we've got to be able to figure out a way to bring these more advanced concepts like alternative assets, private equity things, more down to Main Street. And that's the spinoff, our spinoff, Hilton Tax and Wealth Advisors, what we do. Is that we kind of bring these more advanced of the smart money strategies to more average investors. And we just, it's one of the reasons why we're here for you is because we love alternative assets. And they've just, that's a space that we really have had a lot of success in.
That's amazing. I love that you're trying to bring this type of knowledge and accessibility to your everyday investor instead of the Mitt Romneys of the world. I feel like the top 1% of the most wealthy people in this space, they all know about alternatives and they leverage alternatives. And so it's great that you're bringing that to the everyday person.
Absolutely.
Amazing. And where are you guys based out of?
So we're in Alpharetta, Georgia, which is North Atlanta.
Okay. All the way from Georgia. I understand that you're also here for an event, but he's also here to do the webinar with us too. So we're excited to have you, Mark. Thanks again for that quick intro. A couple of questions for you. And one of those questions that I wanted to ask is, what do you guys do for clients? Like what sets you apart from other advisors? So you've got your everyday advisor, you've got Hilton that's advising. What do you guys do for your clients?
So really what and again, our model is, again, to bring more of these smart money strategies down to Main Street. So through the Hilton True Wealth portfolios, we structure very safe, secure portfolios, but in those we always have an alternative or private equity portion, whether it's 5%, 10, 15, it depends on the client. And then overall, then they have a balanced portfolio, but then we can also teach them and educate them how the wealthiest of the wealthiest invest, because the wealthiest don't invest like retail investors, like in mutual funds and things like that. So, but again, it's our way, and we've had great success of structuring these portfolios and be able to generally people that only have 10 or $20 million can generally get involved with. That we've been able to structure things to where if somebody has 250,000 or 500,000, but just a really nice quality portfolio that is how, again, the smart money invests. So.
Gotcha. And when you say balanced portfolio, bear with me, because this is above my pay grade, which is why we have advisors out there. When you say balanced portfolio, are you referencing diversification, risk level? What does that really entail?
All of it.
Okay. Awesome.
Diversification, allocation, a lot of your advisors that will hear this, of course, on the retail side, that's kind of just a given, but it's done differently on the family office side. So, and again, a big part of what we do is because if we can put a very safe, secure portfolio together, mostly, then that alternative side is where we can get bigger returns and quality returns that will boost the entire portfolio.
Sure.
So we're very much in in that alternative space, and I talked to a lot of advisors too that they should be too, because it really does help overall boost portfolio returns, and then you can actually have a safer portfolio, the rest of the portfolio safer, because you've got that percentage over here in the private equity or the alternative space.
Sure. Amazing. Thank you so much. And I know we had a little additional note on here. What does it mean to be an advisor? Like, what does that mean to you?
What does it mean to be an advisor? Well, I think the main thing is we all as advisors, we need to be there as, we call ourselves consultants, advisors, consultants, or whatever, to really be there to walk clients through the myriad of different options that are available.
It's overwhelming sometimes, right? For your everyday investor, especially who's not super experienced in the stock market, let alone alternatives. It can be really, really daunting if you don't have somebody that's really guiding you. So
yeah, I think, and it's so important that, if there's advisors listening to this right now, is that it's so important, especially in this alternative space, for us to be there to help clients walk through a space that normally they're maybe not used to, and that or a lot of people aren't involved with.
Yeah,
not involved enough with, actually.
We hear some advisors all day, every day are just strictly focused on the traditional side of investing, and I think little by little they're finally catching on and realizing that alternatives are part of a balanced portfolio, and to not be afraid of them either. I feel like a lot of advisors can be afraid of them as well. So that kind of leads into my next question for you, because I was kind of curious what you thought about this. What do advisors think about alternatives? Because my interpretation is that a lot of them, again, lean away from it sometimes. They don't know how to charge their fees on it, or they don't know how to assess alternatives. But what do you see in the market?
Because it can be scary to an advisor too. There's compliance issues and things like that, and I think that it's a space that they need to be involved in. Again, like I mentioned earlier, for a very balanced portfolio. Now, some advisors will probably, if they're on the retail side of the business, are used to alternatives being, real estate investment trusts, or maybe, that's the big one.
Most of them say REITs.
Yes, REITs, or a couple other things. Whereas true alternatives are more that from, individual companies that are issuers that are putting offerings together and things of this nature.
Sure.
I think it's about, overall, advisors are afraid of it, but they really shouldn't be. I think every advisor should really delve in, learn more, try to make the relationships that they need to make, and get to know these issuers and get to know the offerings. And I think you'll find out there's a lot of really good quality people out there in the space. Now, at Hilton, we happen to be pretty risk adverse. The Hilton family happens to be pretty risk adverse. So we tend to maybe gravitate towards, is there ways we can structure offerings to minimize as much risk as possible?
Sure.
I won't go into that too much. Sometimes we go a little overboard with issuers that we need to have assets put up, all of that type of thing.
Sure.
But really, they shouldn't be afraid, and should spend more time learning about the space, alternatives, private equity. And if they do that, I think they're going to find that it's going to be really advantageous to their practices.
Awesome. Well, you heard it here. Mark Miller said. Love it, though. I think that it's great that more and more advisors are starting to learn about alternatives and see the value in alternatives. Hopefully, they expand outside of just the REITs, because as soon as I say, "Do you have you worked with alternatives before?" A lot of them will say, "Yeah, REITs." I'm like, okay, like I see what you're saying, yes, but also no.
REITs are still retail products.
It's still a retail product.
Yeah,
yes. It's not necessarily alternative per se. But thank you so much for that breakdown. I really appreciate that, Mark. I'm also curious. There's a lot of custodians and private custodians out there that handle private investments, obviously directed included, but why work with directed over the others?
Well, because they know what they're doing.
Oh, thank you.
Okay. Yes, absolutely. I mean, the people that are involved here have been in the space a long time.
Yeah.
And we've had good relationship with you and other people that really understand how to do this and the proper way to do this. And just, being straightforward and transparent, there's been some companies that we've been involved with that fall down on the administrative side because it's very important that on this alternative side that is not an issue and shouldn't be an issue. And I think that's one of the things we've appreciated so far about being with Directed.
Well, thank you so much. I know it's crazy. Mark and I have worked together for, we were doing the calculations, over 10 years.
Yes.
We were young bucks back in the day. 10 years. It's kind of crazy. So I'm really glad that you have found me over here at Directed and that you're working with us again in this capacity. And I know it's a newer relationship. We just started this year. I can't believe 2025 is already over, but here we are. But we've been working together again this year, and we're super stoked to have you guys on. I know that you guys are also one of the more unique advisors as well. A lot of the advisors that we do work with, they focus primarily on just alternatives in retirement accounts. But what I love about you guys is that you also do alternatives for the entire portfolio, not just for their retirement accounts. And so it's been fun to also assist you guys with some of those non-retirement accounts here as well. Yeah. Okay, and tell me this, what's important to you, though, when it comes to a custodian? So obviously having the personnel on the team that's, you can trust and that has the knowledge, that's important. Obviously keeping proper records is also important. What about service level? What about accuracy? What about quick, the speed of how fast things happen? Is any of that important to advisors, or
all
is
of it?
Okay, awesome.
Yeah, and from an advisor's perspective, of course, we have administrative folks in our office too, and they're kind of in the day-to-day front lines of that. From my perspective, all you want is you just want it done, or you don't want glitches. And I think that is the biggest thing and the challenge that we've had over year working with some companies, that one aspect or other aspect is not working and not functioning properly. And what we've liked about Directed so far is you guys have enough experience to have every step of the process work properly. And so we don't have to worry. Then our clients aren't going, well, what happened here? What happened there? And especially when you're in a space that's a little bit different, and maybe it's the first time sometimes that clients have stepped into this space.
Sure.
You have administrative glitches, and you can lose that client over those type of things.
Yeah, I mean, we're not dealing with people's, selling a pair of jeans here. We're dealing with people's life savings. So we take it very seriously, and things need to run smoothly. Obviously, we're human, right? Things are going to happen. Things are going to slip up, but I'm glad that we are continuing to meet expectations and exceeding them for you as well. So it's always important. Awesome. Thank you so much. A little bit more that I would like to hear from you is, why should a client have an advisor assist with their self-directed retirement account? Because I'll be honest, we've probably got a lot of people watching right now that don't have an advisor. Now, that's fine. You can certainly do your own thing without an advisor. But why should a client have an advisor when doing self-directed stuff?
Oh, I think it's paramount, because that advisor is going to bring more knowledge, more contacts, more relationships into it, and we'll be able to help do some due diligence and alongside you.
That's huge. The due diligence piece is huge. You'd be surprised at how many clients don't even know where to start with due diligence. They have this private investment opportunity in front of them, and I'm like, well, at least Google the owners. Let's at least start there. Google the name of the company that you're about to send this money to. But due diligence is so critical. And when we take the training wheels off, and the clients are off and running solo, it can be a little bit nerve-wracking. So
most investors can't do proper due diligence.
Right.
So, for instance, just to a little education of some of the folks that are on here maybe don't know about this, but on the family office side, due diligence is probably the number one thing with wealthy people, and it's a big part of every family office, and it's all about vetting the people, vetting the opportunity, vetting the offerings, all of that. So if you can layer that in as an advisor, and you can help with due diligence, it doesn't mean you have to do every bit of it,
right?
But if you can layer that in, then the client is going to feel so much more comfortable, and then everybody's more protected too.
Sure. Oh, and that's really key, is the protection. So what about people who are just starting to really build their wealth? You know, someone who doesn't have 6 or 7 figures yet, should they have an advisor?
Well, I think so. You know, but all advisors aren't built the same. And I think it's important that you do your own due diligence on advisors, and that you have someone that has a myriad of experience, and especially in the space we're talking about, that has been there, done that, and knows how to layer in that due diligence, and be there and truly be a true consultant to you.
Yeah.
And not just trying to bring assets on board, but
Sure.
be a consultant to individual clients.
Awesome. So tell me this, when you guys are looking for new alternative investments to offer to your clients, where do you start? How do you start that search?
So we're fortunate and have a lot of access, and being in the Hilton Financial Group. And we usually start by meeting people in different spaces and different things that we're involved with. We're fortunate to have a lot of people come to us and say, hey, can you put this on your platform? Can you do this for us?
Sure.
But so it all starts with relationships. And, you know, I tell all of my clients when I talk to them too, when it really boils down to in this area, it's about people.
Oh, 100%.
Yes,
Yeah.
it's about the quality of people that you're working with. And that is so we want to make sure that first and foremost, we've got to understand, know the people, get to understand what drives them, why they're doing what are they there just to make a big bucks and make money, or come to the Hiltons because just they want to use our name to put offerings out there or stuff, or are they truly putting value out there into the space? So we're fortunate in our group that we just have a lot of access to a lot of people that with different offerings, and then we can be pretty selective how we go about it.
It's so interesting, though, that even as an advisor, your community and your network and the people play a really, really big part in it.
Yeah.
That just goes to show you, too, you can't just go on Google and attempt to find the best opportunity to invest in, right? It's all about talking to people. It's all about networking, which is funny because we happen to have the Alternative Asset Summit coming up next week. I'm so bummed you're going to miss it. I know you guys came all the way from Georgia this week, and I was hoping you guys would be able to come next week, but we do have our Alternative Asset Summit that's happening next week. That's hosted by Matt Sorensen. And if you go to altassetsummit.com, use the code Lindsay100 if you want to purchase a ticket. That'll get you $100 off your ticket. But we have VIP. Oh, wait, no, VIP's all sold out, right, Angel?
Yes.
Yeah, darn it. Sorry. So VIP is all sold out, but we do still have some general admission tickets and virtual tickets. So to Mark's point, if you want to come to an event with over 200 people live, I think we're at 250 at this point, nearing 300. If you want to come to an event and get in the room with people that love alternative assets, this is the place to do it. So go to altassetsummit.com. It's hosted on the 16th and 17th next Thursday and Friday out in Scottsdale, Arizona. We'd love to see you there live, but it's a great space to learn about alternatives and get in the room and network, just like you were saying. So that was a perfect segue. Thanks for letting me do a little side pitch.
Sure.
Awesome.
Lindsay, I have a question from someone.
Yeah, what's up?
Someone is asking, are alternatives best used as diversifiers only?
Are alternatives used as best diversifiers only? You kind of hinted at this a little bit earlier because risk can also play a part in when you choose alts, but go for it.
I would say from our perspective, yes, that you need to be very careful when you come out in this space and you see really seemingly great things and say, hey, why don't I just take 50% of my money and put it into this? Now, we're fortunate because, again, we can usually put a lot of backstops on our kind of downside risk. But I'm just saying in general, if you're looking at alternatives, a lot of times there's alternatives are what we call naked. that you go out there and you're taking all the risk. So if you take 50% of your money, it may sound like the greatest deal in the world,
right.
Best people in the world, and boy, there's no way this isn't going to happen. But another thing that I'll say here too is, in this space, what we have learned is generally time can do a lot to an offering. Meaning, let's say you go into an offering and it's fantastic now, but you're going to have to be in this for 5, 6, 7, 8 years. There's a lot of things that can come up in that period of time to where that asset is, or that investment is phenomenal right now. 3 years from now, the economy could change. Somebody could, one of the principals could pass away.
Sure.
A lot of things can happen. So my answer would be yes. We believe that these are a portion of portfolios, and should be. And honestly, that's how the smart money invests. Most people think that, like Warren Buffett, great example. Great example.
Who's
they think,
that?
oh yeah, who's that guy? He's Berkshire Hathaway. He's got all his money and all these equities and all of that kind of stuff. The wealthiest of the wealthy have about generally often 60 to 70% of their portfolio safe, secure, ironclad, and they're taking maybe 30%, and they're taking that risk. So along the lines, this is the same thing.
Yeah.
That you have to be, and we guide people with that usually because we have pretty darn good offerings, and they're like, oh, well, can't I just take, make it 30% or 40% because it's great. And so anyway, so
it's very
I would just say
tempting
be
though.
careful.
Yeah.
It's tempting. It is.
And
It is.
it's funny because I think a lot of people will make investment decisions on their own based on their historic decisions. So I've seen so many people who will invest in something and they're like, oh, I'll just do a little sliver. I'll just do, just a little bit. And then a year later, they're like, why didn't I do 50% of my
Sure.
portfolio
And you
in
have
this?
to be careful on
You
that.
have
That's
to be careful.
emotion.
If it
It's too much
sounds too
emotion.
good to be true, it's probably too good to be true, right? Yeah. So always proceed with caution, but thank you for that. Any other questions from the audience, Angel?
Yes.
Okay.
Do you recommend a specific concentration of alternatives, or is it best that your alternatives are diversified?
Concentration in alternatives. What I'm thinking they're saying is like, do mostly real estate or private lending or precious metals or cryptocurrency. What do you think about cryptocurrency, by the way?
Oh, well, we're very big into that space.
Okay.
We think it's really the future, digital assets,
Yeah.
DeFi. So I would probably answer that. And I would say it depends on the size of your portfolio. Okay, if you have a very large portfolio and a big piece of, and it's a big chunk of money, that's say that 10% or 5% or whatever is going to be in that quote bucket, so to speak. Then we might want to diversify it inside that. But
Sure.
it could be just one offering to just complement the rest of the portfolio. So that's probably how I'd answer it. It just kind of depends on the client, depends on the dollar amount that we're talking about, probably.
Got it. Sounds like that person might need an advisor because we want to really give these catered answers, right? And unfortunately, to Mark's point, it's hard to give these really specific catered answers to the masses, and that's why you need an advisor because everyone's risk tolerance is different. Obviously, your age, your overall wealth, the dollar amounts that you're messing with now in different alternatives versus maybe you're just in the stock market and that's it right now. So yeah, very catered, and it sounds like an advisor may be well beneficial for that person.
That's why we as advisors are out there.
Absolutely. Yeah. Any other questions, Angel?
I have a good one for you, Mark.
Yeah.
Is there a specific alt that you're most excited about over the next 5 years?
Well, we just mentioned it. The digital asset space, the DeFi space, is becoming stronger and stronger and stronger. And, here's the thing. People are like, well, how do we know that for sure? Well, we know that for sure because we see what's happening in our country, who is now positioning themselves to be the leader in this space with all our leaders that are positioning it. And I won't, because we don't have time to go over this, but I will tell you they're positioning things to where we're literally moving into the 21st century now, with the entire economies, money movement systems, investment systems. We were just talking earlier about the disruption in AI now. AI is upending traditional finance with this. There's advisors on here that are a lot of, traditional finance guys.
Yeah.
Traditional finance may not exist in 10 years.
Sure.
Which is
They could be
crazy
replaced
to
by
think.
algorithms and
Yes.
AI. It's kind of crazy.
So digital assets, that whole space is we are really moving fast into. We're just about to launch the Hilton Tech Fund. That's going to be primarily starting in the digital space. Just the relationships that we have there to. And blockchain is going to be at the core of all of that.
Absolutely.
So anyway, so that's the space I would say.
Awesome. Thanks so much for that. Any other questions, Angel?
We have a couple. Edward is asking, when using a self-directed IRA, this is a traditional account, to buy real estate, can you talk about any downsides?
Ooh, me or an advisor? I could kick this one off.
Yep.
Yeah.
That might be a Lindsay question.
Let me kick this one off just a little bit. You may have some stuff that you want to add just from an advisor's perspective. Can you read it one more time for me, Angel?
Yes. When using a traditional self-directed IRA account to buy real estate, can you talk about any downsides?
So I would say that what people perceive as a downside with real estate is two things. Number one, they perceive the lack of liquidity as a potential downside. So you always want to think about that. You can't just click a button and sell the property like you can a stock. So that can be something that people consider and are worried about is liquidity. I don't know if it's necessarily a downside, but depending on your situation, hypothetically. The other quote-unquote downside would be that a lot of people get a little bit bummed out that they can't take advantage of depreciation within their retirement accounts assets. So a lot of people think to themselves, well, if I can't take advantage of depreciation or all of these endless deductions that you get with real estate investing, then why would I do it in my IRA? And the number one thing we always remind people of is, well, you don't have to do any deductions and you don't have to do any, cost studies or anything like that, because at the end of the day, there's no taxes to counter. So a lot of people get stuck on that. They say, well, if I can't use the deductions and the depreciation right now, I lose it, and then I can't use that depreciation. So typically in your standard type of real estate deal, you can't use the depreciation. But if you run into a situation where UBIT is involved, you do have the opportunity to get rid of those taxes with some depreciation and deductions. But I would say those are the two quote unquote downsides. Is some people don't like that there's not a lot of liquidity, and some people don't like that you can't utilize deductions on every single deal. But in reality, the deductions and depreciation can come into play if you're trying to counter some UBIT tax that could arise. Anything to add there?
No, that was excellent.
Oh,
Very
awesome.
good.
Well,
And
thank you.
The only other thing I would say is then it just kind of goes back to the individual offering that you're looking at, and
Yeah.
just to weigh the pluses and the minuses for you, and is it going to fit in overall in a portfolio in a qualified account?
Yeah. I mean,
So-
when you say real estate, that could also mean so many different things.
Oh, yeah.
You know, is it a syndication? Is it a multifamily property? Is it a commercial property? Is it a residential property? Is it a short-term loan? Is it a long-term, rental? Is it a short-term rental, long-term rental? It can mean so many different things. So real estate as a downside can look different to every single person. But hopefully that answers your question, Edward. Any other questions, Angel?
We have one regarding private lending. Willie is asking, what is the average rate of return you are seeing in real estate private lending? So, yeah, Mark,
Ooh.
I don't know if you deal with private lending. Maybe you can touch on that.
Do you deal with private lending?
Yeah, actually,
Okay.
we have a division, Hilton Finance,
Yeah,
where
take it
we
away.
do private and debt offerings. And now, I wouldn't say there's a specific rate. I know what they're asking there. It's
Yeah.
like, I mean, right now, though, I mean, yields are, and when we offer yields on our platform, 7, 8, 9, sometimes 10. It depends on the structure,
Sure.
what we have in the different areas in Hilton Finance. But I'm not sure if that totally answers your question, but But you know, private lending it's a big area. And funny that you do say that, though, because we're looking at structuring some things on the blockchain now that are going to streamline private lending, and there's going to be incredible things to come in that space. So ultimately that will trickle down to individuals that will be able to see, by the way, more liquidity, things of that type of thing when they're involved in private liquidity, private lending. So so anyway, it's an exciting area too.
Yeah,
it's going
but
to be disruptive.
At the end of the day, it can vary. So it all depends on those private deals that you arrange. I would say that I see a lot of groups that do private lending on a regular basis. That's like their bread and butter. And some of them will not loan out money without getting at least 12% return. You know, that's where they're sticklers on, right? But it comes back to how many loans do you have going at once? What are the sizes of those loans? Are you lending out, $1,000? Are you lending out $1 million? Obviously, returns can vary there too. So it sounds like it's kind of all over the place, though, as far as returns. There's not necessarily a good go-to number. But I get that question a lot on just IRAs in general. And there's a common misconception that an IRA is actually an investment itself. And so we have a lot of people that will ask on these podcasts even, they'll say, what's the rate of return you guys typically see in a self-directed IRA? I'm like, well, it's a loaded question. It's all over the place. Yes. It's so dependent on what you ultimately invest in, because we open up the IRA for you, the self-directed IRA, or solo 401k, or HSA, or ESA, or all the different kinds of retirement plans that are out there. But we open up the account and you put the money into it. That money is going to sit there until you identify the alternative asset that you want to invest in. So the IRA itself doesn't offer a return when it's with our institution, because the cash is going to sit there until you choose an investment. But if you went with something like Bitcoin a few years back, you may be experiencing a 40% return. If you go with private lending, you may experience a 9 or 12% return. Ultimately, it's just dependent on you and what investment you identify, or what investment your advisor identifies for you.
That is true.
Yes. Any other questions for us, Angel?
I have a question for Mark. How do you start the conversation with a client who's only ever invested in stocks and mutual funds?
That's great. It's a very good question. Really, we just, again, when you have a conversation to get them to understand this is just one portion of your portfolio. So I won't go into too much, but we've had to bringing these family office concepts more down to Main Street, so to speak. We use, and many of the advisors that may be listening have heard of kind of a bucket concept. And again, a smart money investor won't generally use that, but we're kind of trying to mimic that. So we'll have a bucket that is very safe, secure, maybe guaranteed investments. Then we'll have a bucket that's a guaranteed income bucket. Then we'll generally have a managed money or stock bucket. And then this is one other bucket, the private equity alternative bucket. So it's going to be, the conversation is just going to be, hey, all this bucket does is help us boost our portfolio returns, and we're managing the risk of that in the rest of the portfolio. So
I'm taking notes, because I have had conversations. I've been in this industry for over 13 years, and I have had similar conversations with a lot of my family members who are still only in the stock market. I'm like, guys, you know what I do? For 13 years, I'm talking about alternative assets.
They're missing out, aren't they?
They are totally missing out. So I'm taking notes as well. I really appreciate that insight, though, as to how to start that conversation. I'd also say that one of the big things you want to identify, too, is why are they so hesitant? Are they just they're happy, they're good with their stocks, and they don't think that it needs to be any better? Do they not realize the potential? It's interesting what the actual core issue is. Oh, yeah.
Well, we've got a bubble in almost every asset class, mainly because there's massive amounts of money being pumped into the world.
Yeah.
So if they know that space, if they've been doing that for their whole lives, and it's pumping right now, think of it from their perspective. Why should I change?
Yeah.
Right. So It is about diversification and allocation, though, and the wealthiest will still be smart enough to diversify when things are pumping in any area.
Very true.
Because here's the thing, it's pumping now, but eventually it's going to pop.
Yep.
The bubble is going to pop.
Right.
In one way or the other. We'll see what that looks like in the next several years. So then they're caught flat-footed.
Right.
And the longer it goes, it means the harder it's going to fall.
Yep.
So then all of a sudden, if there's, I just keep investing in the stock market. Look, it's going up, it's going up. And it's, it's human psychology.
Sure.
It's the way individuals are. But asset allocation, diversification, having a good, balanced portfolio is how the wealthiest of the wealthy invest and how everyone really should invest.
Absolutely. That's how we should all be doing it. Because I don't know about you guys, but, wealth is obviously not everything in life, right? But it can most certainly provide you with a more comfortable life. So I think that it's quite critical, in my opinion.
Yes, I once heard that money isn't everything, but it can buy a lot.
Yeah, it sure can. Yeah. Have you ever seen someone sad on a jet ski? Because I haven't. Yeah.
Yes.
It's hard to be sad on one of those.
Yes.
Awesome. Any other questions for us, Angel?
I do have one from Heather.
Yeah.
She is asking, what is the minimum investment amount that you work with? Do you work with clients who may only have or want to start with $50K or $100K to invest in alternative assets, or is there a minimum threshold?
So that one's for you, Mark. I'll take that one after you as well from a self-directed custodian perspective, but from an advisor perspective.
Yeah, generally we're going to work with folks of $250,000 and above.
Okay.
So we need minimum of $250,000 to build a diversified portfolio.
Is that pretty typical with an advisor?
Not necessarily.
Okay.
So it's like in the family office, I'll tell you our minimum is 10 to 20 million.
Well, shoot.
So that's a little
Count me
bit
out.
different. But on the Hilton Tax and Wealth Advisor side, one of our companies, that again, our goal is to help, folks that are a little more average investors, but we still need to have a good enough chunk of money to be able to have a decent diversified portfolio. But most of our clients, their portfolios are in the 500,000 to $1 million plus range, ultimately.
Okay.
So I that's probably how I'd answer that.
Awesome. No, that was great. And from a custodian perspective, we also get the question a lot, what's the minimum that you have to use and invest to get started with you guys? And it's kind of a loaded question because we don't really have a minimum. We have flat rate costs though, and our pricing is flat rate. So I would prefer for people to look at the pricing and make sure you're going to get returns that are over our pricing, our annual pricing. But when it comes to us as well, we don't have a minimum here as far as what you can open up an account with. We've had people open up accounts with $3,000 and they'll stick it into crypto and it explodes. And so they don't care about the flat rate fee.
And then it's 100,000.
And then suddenly
In
it's
5
100,000.
days.
Yeah, quite literally. Yeah. Isn't that the dream? But yeah, we've had people like even Mark Kohler, one of our founders, he's talked about how he has purchased cattle with his HSA. So $2,500 threw that in there and let it grow in the cattle industry. So
that's a new one. That's interesting.
They get really creative out here, Mark. I tell you, I don't know if there's many different investments that we haven't seen actually happen. So it's fun to see the diversity and also the creativity that people get into with their retirement accounts, so cattle included. So
yes, yeah.
That's one
we'll
of
have
them.
to talk to you guys about the Hiltons. We'll have to talk about some cattle.
Yes.
So
Absolutely. Yeah, got to get your clients invested in some beef.
yes, yeah.
Awesome. Any other questions?
I'm all for that. I love it.
Absolutely. Hey, diversification, right? All right, Angela. Okay, awesome. Well, thank you all so much for coming today. Mark, was there anything else that you wanted to share as kind of final thoughts?
No, I just thank you. Thanks for having me. And I would just say Directed's a wonderful company to work with. We've been very pleased with you, and we'll continue our relationship with you and hoping for the long term.
Oh, we love it. We love advisors that love alternatives, and we love working with Mark Miller. So thank you so much, Mark, for coming and being the advisor pro on our session for today. Thank you all so much for joining us again on Friday. I know it's a little bit different. If you are itching for more information about how to self-direct or how to get started, book a phone call with Directed Trust Company. Scan that QR code. You'll be able to get some one-on-one time with any of the representatives here, and we're happy to answer your questions about alternatives in general, self-directing, you name it, we're here to help. Last thing that I will leave you guys with once more is in regards to that event that we mentioned that's happening next week. So Matt Sorensen is hosting the Alternative Asset Summit. That's next Thursday and Friday in Scottsdale, Arizona. There are some virtual options. I'm sorry, VIP tickets are sold out. We've got some GA still, but head on over to altassetsummit.com. Use the promo code Lindsay100 to get $100 off your ticket if you do plan to join us. But that is the space to be in if you're looking to learn more about alternatives. So whether you're an advisor or a client or just someone who loves learning, join us live or virtually next week for the Alt Asset Summit. But thanks again, everybody, for joining us. Have a wonderful weekend. Thanks again.
And thank you, everyone, for listening. A quick disclaimer and reminder. This presentation does not constitute an attorney or CPA-client relationship, and it is always in your best interest to consult competent legal and tax professionals when conducting your own personal transactions.
We also want to make sure you know this is not investment advice or financial advice. We're just trying to give you education, ideas, and strategies you can take to your professionals or conduct your own research on. We'll see you next time.